Hey everyone, my name is Alex Morgan, and today we're breaking down one of the most important macro shifts happening in global markets right now, a shift that most retail investors are missing. It's what I call the big rotation, and in 2026, gold is leading silver in a way we haven't seen in years. Now, if you've been watching the metals space, you've probably noticed something strange. Silver has strong industrial demand, solar demand is still growing, EV production continues, AI data centers are expanding electricity infrastructure. On paper, silver should be outperforming, but it's not. Instead, gold is surging ahead. And that divergence tells us something critical about where capital is flowing, and more importantly, what large institutions are preparing for next. So today we're going deep. We're looking at capital flows, Federal Reserve policy, real interest rates, debt dynamics, geopolitical tension, ETF positioning, central bank accumulation, and what all of this means for both gold and silver going forward. We'll also explore 3 possible scenarios for the rest of 2026 and into 2027, and which metal could outperform next. Let's start with the foundation. The macro backdrop in 2026 is fundamentally different from the 2020-2022 cycle. Inflation has cooled from peak levels, but it hasn't normalized to the Federal Reserve's 2% target. Core services inflation remains sticky. Wage growth is slowing but not collapsing. Meanwhile, U.S. government debt has crossed historic thresholds, and Treasury issuance remains elevated. Here's the key shift. Real rates are no longer aggressively rising, but they're not collapsing either. The Federal Reserve has paused after a long tightening cycle, and markets are now pricing gradual rate cuts into late 2026. Historically, gold performs best when real yields are falling or when financial stability risks rise. And in 2026, we're seeing both pressures begin to build under the surface. The U.S. 10-year Treasury yield has stabilized, but volatility remains high. The dollar index has stopped surging but isn't breaking down either. This environment, uncertainty without outright crisis, is exactly where gold begins to quietly attract institutional allocation. Now here's where the rotation becomes clear. Central banks globally have continued accumulating gold reserves at an elevated pace. Emerging market central banks, particularly those seeking to diversify away from dollar exposure, are steadily increasing gold holdings. This is not retail momentum. This is structural accumulation. Silver does not benefit from this same central bank demand dynamic. Gold is monetary metal. Silver is hybrid, part monetary, part industrial. And in a world where sovereign debt levels are extreme and geopolitical tensions remain elevated, monetary characteristics matter more. The big rotation is not about hype, it's about capital behavior. ETF flows in 2026 show renewed inflows into major gold-backed funds after years of stagnation. Meanwhile, silver ETFs have seen more volatile and inconsistent positioning. Futures positioning shows managed money increasing net long exposure in gold faster than in silver. That tells us institutions are hedging macro risk, not chasing industrial expansion. Now let's examine industrial demand, because this is where silver's story gets complicated. Silver demand from solar panels remains strong. The United States continues expanding renewable capacity under infrastructure initiatives and private sector investment. Data center growth, particularly AI infrastructure, is increasing electricity consumption, which supports grid expansion. That should help silver demand. However, silver supply constraints have been partially offset by recycling and substitution efficiency improvements. Additionally, industrial demand is cyclical. If U.S. economic growth slows in the second half of 2026, which many leading indicators suggest is possible, industrial silver demand could moderate. Gold, on the other hand, thrives in slowdowns. If growth slows but inflation remains above target, a stagflation-light environment, gold becomes more attractive as a store of value. Silver's industrial component becomes a drag in that scenario. Now let's talk about the gold-to-silver ratio. Historically, when macro uncertainty rises, the ratio expands, meaning gold outperforms silver. When economic expansion strengthens, silver outperforms, and the ratio compresses. In 2026, we are seeing the ratio remain elevated. That confirms capital is prioritizing safety over cyclicality. This is the rotation. But here's the nuance most retail investors miss. Silver often lags gold at the beginning of major precious metal bull cycles. In 2001-2003, gold moved first. Silver followed later with explosive momentum. The same dynamic occurred post-2008. So the question isn't just why gold is leading, it's whether silver is building pressure for a later catch-up move. To answer that, we need to examine liquidity. Liquidity drives silver. When financial conditions ease and speculative capital returns, silver tends to move faster than gold due to its smaller market size and higher volatility. If the Federal Reserve begins cutting aggressively in late 2026 due to economic weakness, liquidity could expand rapidly. In that scenario, silver could outperform. But if rate cuts are gradual and inflation remains sticky, gold likely maintains leadership. Now let's introduce 3 forward scenarios. Scenario 1. Soft landing. In this case, U.S. growth slows modestly but avoids recession. Inflation gradually declines toward 2.5 to 3%. The Fed cuts rates cautiously. Real yields decline slightly but remain positive. In this environment, gold continues grinding higher, supported by central bank buying and moderate ETF inflows. Silver rises but underperforms due to slower industrial expansion. The gold-to-silver ratio remains elevated. Scenario 2. Stagflation risk. Growth weakens sharply while inflation remains stubbornly high due to energy volatility or supply constraints. The Fed is limited in aggressive easing. Real yields decline meaningfully. Gold outperforms strongly. Silver struggles initially due to industrial slowdown, but later benefits from monetary demand if investor panic increases. Scenario 3. Liquidity shock followed by aggressive easing. If credit markets tighten abruptly or a financial instability event occurs, the Fed could pivot quickly. Initial liquidation may hit both metals temporarily, but once easing begins, silver historically accelerates faster due to speculative inflows. This third scenario is the only one where silver decisively outperforms gold in the near term. Now let's talk about U.S. investor psychology. American investors are heavily equity-focused. The S&P 500 continues attracting passive inflows. As long as equities remain elevated, precious metals struggle to dominate mainstream attention. But valuations remain stretched. Corporate earnings growth is slowing. Margin compression risks are rising. If equity volatility increases in late 2026, portfolio diversification flows into gold could expand significantly. Silver, again, depends on risk appetite. Gold is a hedge. Silver is a leveraged macro trade. This distinction is why gold is leading in 2026. Another critical element is fiscal dominance. The United States is running persistent large deficits. Treasury issuance remains elevated. If demand for treasuries weakens structurally, yields could stay volatile regardless of Fed cuts. Gold benefits from fiscal instability narratives. Silver does not directly benefit from sovereign debt hedging. Now let's consider the dollar. If the US dollar weakens meaningfully in the second half of 2026 due to rate cuts or geopolitical shifts, both metals benefit. However, gold tends to respond first and more consistently to dollar weakness. Silver requires risk appetite confirmation. Let's examine mining supply. Gold mining supply growth remains constrained due to underinvestment in exploration over the past decade. Silver mining faces similar structural constraints, but a significant portion of silver supply comes as a byproduct of other metals like copper and zinc. That makes silver supply partially dependent on broader industrial mining cycles. If global industrial mining slows, silver supply could tighten, but so could demand. This supply-demand balance reinforces gold's current leadership. Now here's something most analysts underappreciate. Volatility. Gold volatility has declined relative to 2020 levels. Silver volatility remains elevated. Institutional allocators prefer lower volatility assets when hedging portfolios. That favors gold in asset allocation models. So where could gold go next? If real yields trend downward and ETF inflows accelerate, gold could challenge new all-time highs in 2026. A sustained breakout could trigger momentum flows and systematic buying from trend-following funds. Silver would likely follow, but the magnitude depends on liquidity conditions. If economic data weakens sharply and the Fed cuts aggressively, silver could stage a powerful catch-up rally into 2027. If growth stabilizes and inflation gradually cools, gold likely remains the leader through the cycle. Now let's talk positioning strategy for a U.S. investor. If your goal is portfolio insurance, gold allocation makes sense in a late-cycle macro environment. If your goal is speculative upside tied to monetary easing and liquidity expansion, silver offers higher beta, but also higher risk. The big rotation is not anti-silver, it's pro-capital preservation. Institutions are positioning for uncertainty, not expansion. And until liquidity meaningfully expands or industrial growth reaccelerates, gold maintains the structural advantage. Watch real yields, watch the dollar, watch credit spreads, watch equity volatility. These will determine whether silver eventually takes leadership. If gold continues attracting central bank demand and ETF inflows while silver lags, the ratio stays elevated. If liquidity floods markets and risk appetite surges, silver can rapidly compress that ratio. The key takeaway is this. Gold is leading because macro risk is rising beneath stable surface conditions. Silver will lead when liquidity returns. As we move deeper into 2026, the battle between inflation persistence and economic slowdown will define the next move. And whichever side wins, that will determine whether gold extends its dominance or silver stages its comeback. For now, the rotation is clear. Capital is choosing safety. But markets evolve, and the second phase of a metal cycle often belongs to silver. The question isn't whether silver moves, it's when. If you found this breakdown valuable, subscribe for deep macro analysis every week. We don't chase headlines here. We follow capital flows, institutional behavior, and structural trends. I'm Alex Morgan, and I'll see you in the next one.